Hey there, finance fanatics. Jim Cramer here, ready to break down the world of dividends. Think of dividends as a little bonus companies give to their shareholders. It's like getting a slice of the profit pie. Now, the dividend yield, that's where the real fun begins. In simple terms, the dividend yield tells you how much cash money a company is throwing your way compared to its stock price. It's like figuring out how much bang you're getting for your buck, but instead of a burger, you're getting cold, hard cash. Who doesn't love a little extra cash in their pocket, am I right? Now, let's talk numbers. Numbers can often seem intimidating, but they don't have to be. When it comes to understanding the dividend yield formula, it's all about breaking it down into simple, digestible parts. Don't worry, I promise it's not as scary as it sounds. In fact, once you get the hang of it, you'll see how straightforward it really is. Think of it as a tool that helps you understand how much bang you're getting for your buck when you invest in a company's stock. The dividend yield formula is simpler than boiling water. If you can make a cup of tea, you can definitely grasp this concept. It's all about understanding the relationship between the dividends a company pays out and the price of its stock. Ready for this? Here it is. Dividend yield equals annual dividends per share divided by price per share. This formula helps you determine the percentage return you can expect from dividends alone without considering any potential stock price appreciation. See? Easy peasy. Let's say a company, we'll call it Cash Cow Inc., pays out $2 in annual dividends per share, and its stock is trading at $50. This means for every share you own, you get $2 in dividends each year. You just plug those numbers into our magical formula. $2 divided by $50 times 100% equals 4%. This calculation shows you the yield, or the return, you get from dividends relative to the stock price. Boom! Cash Cow Inc. has a dividend yield of 4%. This means that just from dividends alone, you're earning a 4% return on your investment. It's a great way to gauge the income potential of your stock investments. That's a 4% return on your investment just from dividends, baby. And remember, this doesn't even take into account any potential increase in the stock price. So the next time you're evaluating a stock, don't forget to check out its dividend yield. It could be a key factor in your investment decision-making process. Now, why should you care about this fancy-sounding dividend yield? Well, it's music to the ears of income investors. These are the folks who love a steady stream of cash flow, like retirees or anyone who likes seeing green in their account. Think of it like this. You're buying a rental property. You want to know how much rent you'll rake in each month, right? Dividend yield is like knowing the rental income of your stock investment. The higher the yield, the more cash you're pocketing from your investments. It's as simple as that. A straightforward way to gauge your returns. Section 4. Reading the signs, interpreting dividend yield like a pro. Now, before you go chasing the highest dividend yields like a kid in a candy store, hold your horses. It's easy to get lured by the promise of high returns, but there's more to the story than just the numbers. A high yield doesn't always mean a fantastic investment. It's like finding a $20 bill on the sidewalk. You're excited, but you also wonder why it was just lying there. Sometimes things that seem too good to be true often are. A high dividend yield can be a sign of underlying issues within the company. Sometimes a high yield can be a red flag. It might mean the company's stock price has taken a nosedive, or maybe they're paying out more in dividends than they can actually afford. This could be a sign that the company is in financial trouble, and they are trying to attract investors by offering high dividends. That's not a good sign. Always do your homework, folks. Look at the company's financials, their growth prospects, and their track record of paying dividends. Check their earnings reports, balance sheets, and cash flow statements. Are they consistently profitable? Do they have a lot of debt? These are crucial questions to ask. Don't just jump into bed with the highest yield without doing a little due diligence. It's also important to consider the industry the company operates in. Some industries are more stable and have a history of paying steady dividends, while others might be more volatile. For example, utility companies often have stable dividend payouts, whereas tech companies might not. Diversify your investments to spread the risk. Remember, a well-informed investor is a successful investor. So, take your time, do your research, and make smart choices. Section 5, dividend yield versus payout ratio 2Ps from different pods. Now let's talk about the dividend payout ratio for a hot second. It's like the dividend yield's cousin. They're related, but not quite the same. The payout ratio tells you what percentage of a company's earnings is being paid out as dividends. Think of it like this. You're at a buffet, and you've got a plate full of delicious earnings. The payout ratio is like deciding how much of that food you're going to eat right now, dividends, versus how much you're going to save for later, reinvesting in the business. Section 6. A tale of two companies when high yield isn't so fancy. Let's say we've got two companies, Steady Eddie and Risky Business. These two companies represent different investment philosophies and risk appetites. Understanding their differences can help investors make more informed decisions. Steady Eddy has a dividend yield of 3% and a payout ratio of 50%. This means that for every dollar they earn, they pay out 50 cents as dividends to their shareholders. The remaining 50 cents are reinvested back into the company. They're like that reliable friend who always pays their share of the bill on time. You can count on them to be consistent and dependable, never missing a payment and always contributing their fair share. Risky Business, on the other hand, has a juicy 8% yield but a payout ratio of 90%. This means they pay out 90 cents of every dollar they earn as dividends, leaving only 10 cents to reinvest in the business. They're like that friend who always picks the priciest thing on the menu but forgets their wallet. They might seem flashy and generous at first, but their habits could lead to trouble down the line. Steady Eddy is reinvesting half of their earnings back into the business, which means they're likely to keep growing and increasing those dividends over time. This reinvestment helps them innovate, expand, and improve their operations, ensuring long-term stability and growth. Risky Business, well, they're living on the edge. By paying out almost all of their earnings as dividends, they leave little room for error or unexpected expenses. This high payout ratio can be risky, especially if the company faces financial difficulties or market downturns. They're paying out almost all of their earnings as dividends, which might not be sustainable in the long run. If their earnings decrease or they encounter unforeseen challenges, they may struggle to maintain their high dividend payouts, potentially leading to cuts or suspensions. See? High yield isn't always as glamorous as it seems. While a high dividend yield can be attractive, it's essential to consider the sustainability and long-term prospects of the company. A lower yield with a solid reinvestment strategy might be a safer and more rewarding choice in the long run. So, next time you're evaluating dividend stocks, remember to look beyond the yield and consider the bigger picture. Section 7. The bottom line, dividend yield, a piece of the puzzle. So there you have it, folks. The dividend yield is a valuable tool for income investors, but it's just one piece of the puzzle. Don't get blinded by those juicy yields without considering the bigger picture. Look at the company's financials, their growth potential, and their dividend history. Remember, investing is a marathon, not a sprint. And like any good marathon runner, you need to pace yourself, stay hydrated with knowledge, and make smart decisions for the long haul. Now go out there and conquer the markets, my friends. And always remember to invest responsibly.